By 2035, your job might be done by AI and your tax bill could double, or it could disappear entirely. Governments are already panicking because the old tax system built on human wages is breaking. AI is creating trillions in new wealth while wiping out the payroll taxes that fund pensions, healthcare, schools, roads, everything. In 10 years, you could be paying 20 to 30% VAT on every purchase, or getting a monthly check from the government funded by robot taxis. Billionaires might pay almost nothing on their AI fortunes or face wealth taxes that force them to sell stock. The rules you know today are dying. The new one will decide whether you thrive or just survive. Today we are looking ahead realistically to 2030 to 2040 based on what top economists, tax policy experts, the IMF, McKinsey, PwC, and even world leaders are already debating in 2026. No SCI fantasies, no doomsday panic, just the most likely path taxes will take in an AI dominated world, and exactly what you should do right now to protect your money and income. Let's break it down. The core crisis governments face is simple and terrifying. AI is exploding productivity while shrinking the number of human workers who pay income tax and payroll tax. In most developed countries, payroll taxes, social security, Medicare, pension contributions make up 40 to 50% of government revenue. McKinsey and Goldman Sachs already forecast 20 to 40% of current jobs could be automated or heavily augmented by AI by 2035. That means the human wage base collapses. At the same time, AI adds 15 to 25 trillion dollars a year to global GDP by 2030 according to PwC estimates. So, governments have a massive surplus of new value and a massive hole in their old revenue model. They have three realistic paths forward, and all three are already being tested or seriously proposed. Path 1: tax the machines directly. The robot tax idea Bill Gates mentioned years ago in gaining real traction. In 2026, visions are being piloted or debated in European Union, South Korea, Singapore, and some US states. The logic is straightforward. If a robot replaces a human worker who used to pay income tax and social security contributions, tax the robot company at a similar rate. Pros: revenue neutral discourages mass displacement too quickly. Cons: impossible to define what counts as a report. Companies move offshore or reliable jobs, innovation slows. Likely outcome by 2035: some narrow variants, reverse tax credits for automation, surcharges on highly automated industries or digital services, taxes on AI giants. But a full global robot tax is unlikely. Path number 2: tax extreme wealth and capital much harder. AI is creating winner-take-all economics faster than anything we have seen. OpenAI, Anthropic, Nvidia, Google, Microsoft capture most of the value. Wealth taxes on billionaires or ultra-high net worth individuals are back on the table. Elizabeth Warren's old proposal, 2% on 14s or $50 million higher above 1 billion, is being revived in the US. France, Spain, and several developing nations already have variants. In 2026, the debate is louder than ever as AI stock gains create paper trillionaires. Pros: targets idle capitals, funds reskilling, and social programs. Cons: capital flight, valuation battles, constitutional fights in places like the US. Likely outcome: modest wealth taxes are significantly higher capital gains rate on very large fortunes will appear in some countries by 2030, especially Europe and parts of Asia. But broad wealth taxes will remain politically toxic in many places. Path number 3: shift to consumption taxes and VAT explosion. This is the most probable path because it is the easiest to collect and hardest to evade. Europe already has 20 to 27% VAT rates. In the US, some economists push for a national VAT or carbon tax to replace income tax. In developing countries like Pakistan, sales tax and GST could climb from the current 17% toward 25% or higher. Digital services taxes and carbon taxes on AI data centers are already being rolled out in 2026, and its pros captures value when AI created wealth is spent, almost impossible to hide. Its cons, regressive hits lower income households hardest unless offset with rebates or UBI. Likely outcomes, the dominant shift, consumption taxes will rise globally, probably combined with targeted taxes on AI profits, data, and energy use. Now, the wild cards, universal basic income and full abundance taxation. And if AI creates so much surplus like that scarcity ends for basics, governments could fund UBI from taxing AI profits, data flows, or wealth. Andrew Yang's 2020 idea is now running in real pilots across the US, Canada, Europe, and parts of Asia. If UBI becomes widespread, it is funded by higher copyright taxes on AI companies, wealth taxes, or VAT. The extreme abundance view, Musk and the others say reports make work optional and scarcity obsolete would eventually make income tax irrelevant. But governments would not surrender revenue easily. We are more likely to see hybrid systems, UBI for the most people funded by taxing the AI surplus while high earners still pay income or capital taxes. What does this mean for you right now in 2026? Short term, next 5 years, income taxes stay similar or rise slightly for middle earners to plug gaps. Capital gains rates could increase on very high earners. Automation taxes or AI profit taxes will hit big tech hardest. Consumption taxes creep up everywhere. Long term, less reliance on wage and payroll tax, much more on consumption, wealth, capital income, and AI specific levies. How to position yourself today? Number one, build income streams taxed at the lowest rates, long term capital gains, qualified dividends, business profits with deductions. Number two, max every tax advantaged account before rules tighten. Roth IRA, HSA, retirement plans. Number three, own productive assets like stocks, real estate, businesses that benefits from AI growth and can be borrowed against tax efficiently. Number four, upskill fast with AI tools in human AI, collaboration tools, creativity, strategy, ethics, oversight, so your income stays high even as taxes shift. Number five, watch policy closely. Tax changes will come suddenly once revenue holes become undeniable. The future of taxes is not about fairness debates, it is about governments scrambling to survive in a world where value is created with almost no human labor. The winners will be people who adopt early, build tax efficient income, own growth assets, stay adaptable. If this made you rethink how tax might look in 10 years, hit the like, subscribe, and comment. Which tax shift scares you most? Robot tax, wealth tax, higher VAT, or something else? Or do you think abundance makes taxes obsolete? Alright, everyone, thanks for watching. The AI economy is rewriting the tax rule book. Get ahead of it now. See you next time.